Hi, I'm Steve LaFrance, and April and May reminded us that markets don't always roar. Sometimes they quietly climb to new highs. April was one of the strongest months we've seen in years. After a choppy March, the S&P came roaring back, gaining 10.4% during the month. And that momentum carried into May. U.S. equities pushed to fresh all-time highs, and the advance has been broadening in ways that matter for long-term investors. Looking at year-to-date performance, the gains aren't limited to one corner of the market either. The S&P may be up over 11%, but small caps are up over 18%, while international markets are up over 14%. Emerging markets, which are tied to the AI supply chain, are up over 25% and have matched the NASDAQ with an 82% return since 2024. That mix of strong earnings, broad CapEx, and resilient consumer demand is why this rally feels more grounded than speculative. The clearest driver is AI and the related capital spending. What began as a handful of headline names has turned into a real build-out across chips, data centers, networking, and the power and cooling that make those systems work. That investment is showing up in corporate results and forward earnings expectations, not just in a few stocks, but across suppliers and infrastructure companies. That's the kind of breadth that helps markets keep going. At the same time, the consumer has been resilient. Yes, gas is higher and people feel it at the pump, but retail activity outside of fuel has held up. Labor markets remain a support. Unemployment is still just above 4% and wages are growing in the mid-single digits, which helps explain why spending has not collapsed. So while headlines focus on higher energy, households are still buying and businesses are still investing. There's also a new market event to watch, mega IPOs, led by names like SpaceX, which has prompted major U.S. index providers to reconsider the rules governing benchmark index inclusion. SpaceX was reportedly valued at approximately $1.25 trillion in private markets, which helps explain why its public debut could be one of the largest IPOs ever, and why index rules and passive flows are part of that conversation. Here's what to watch next: yields, energy, and incoming data. 10-year Treasury yields are higher than a year ago and remain a key sensitivity for valuations. Oil and gas prices are elevated versus last year and can affect sentiment and pockets of spending. And upcoming inflation prints and payrolls will tell us whether the labor inflation mix is cooling or staying stubborn. So what should you do? For most investors, the answer is unchanged: stay disciplined. If your goals and risk tolerance haven't changed, your allocation probably shouldn't either. So stay disciplined, watch the data, and keep your plan on track. Thanks for listening and for your trust and confidence.